Welcome back to Trading Hour on CNBC-TV18. Nifty as of now managing to hold on to gains of 34 points, 25,940 around that mark. Broader end of the market continues to do well. But let's now go across to Nimesh, who is joined by Alexander Redman, Chief Equity Strategist at CLSA from the CLSA India Forum 2025. Nimesh, a lot of excitement happening there, but we want to hear this chat in terms of the strategy that is going to be coming in for the India side and global strategy as well.
Well, absolutely, Vinay. Thanks for tossing into me. So I've got with me Alexander Redman. He's the global equity strategist at CLSA. Redman, thank you very much for joining and talking to CNBC TV18. Your views are widely followed in India, and they really look up to your views. A lot to ask you, but I want to start with the first. What is the CLSA base case as far as the India-US deal is concerned? I'm asking this because India has relatively underperformed because of those concerns of a delay in the US tariff deal.
Well, look, thank you very much for having me on your show this morning. I still have an overweight allocation towards Indian equities. It is significantly less than I had last year, but I certainly see it as a potential 2026 rotation story. The way I look at India is it has been going through an adjustment process over the last 12 to 18 months, a very important adjustment process. And you have seen forecasts being trimmed for GDP and EPS expectations. There has been a modest depreciation in the currency, which I believe was necessary. You've seen a contraction in relative ROE. You've seen an exiting of foreign institutional investor flows. And you've also seen the peak in this cycle's deal flow. And I guess, slightly less significant versus the other five, you've seen a little bit of compression in valuations as well. Okay, so I look at India from the perspective of it having gone through an adjustment process of these 6 individual metrics that I mentioned over the last 12 to 18 months. So its investment case, I think, in absolute terms, is not that much more attractive than it was a year ago, but in relative terms going into 2026, this is where it could make a big difference. Because obviously the elephant in the room is the point at which the North Asian Pacific AI trade begins to unfold. Obviously, Korea has had exceptional performance this year, Taiwan as well, to a lesser extent China. Investors that I talk to are, I think, necessarily now beginning to do some work on a potential rotation trade. ASEAN, relatively small, but it does come up in the discussion, but India being the obvious example. So I see it from a perspective of there being not much carrot, but potentially quite a lot of stick.
Sure.
So people looking for a refuge for that North Asian allocation that could find its way to India, where there's been a significant divestment over the last year. But I would say the Indian investment case versus this time last year has not improved that much, albeit that the adjustments that I talked about, I think, are very important.
Sure. Alex, when you talk to your global investors and within your team as well, what's the reason for such a long delay for the India-US deal to happen? We were the first to start when the negotiations started, and probably we're the last one to get a deal done. And we're still at 50%, which is among the highest, along with Brazil.
Right.
What's your sense? What's the base case? Will the 50 come to 25, or you expect even the 25 would be further, drill down to sub 20%?
I would imagine that the tariff rate on India will compress beyond 25.
Beyond 20.
I mean, if you look at the modus operandi of the Trump administration with other trade partners, typically the tariff level has started very high. You have these relatively maximalist negotiating stance at the beginning, and then ultimately that unwinds. We've seen that pattern with most obviously with China. But equally the EU and other trading partners where, there has been ultimately an agreement. In terms of the scheduling, I mean, that's really up to sort of the Trump administration, really. And I think it caught, certainly us by surprise, as I think most market participants, the aggressiveness to which the tariffs were applied to India, which coming into this year, we thought was relatively well insulated from the whole, tariff and trade issue across emerging markets. But like others, it will clearly be unwound as we go into next year. Yes, I think that deal is relatively close.
Sure. Alex, from a global perspective, I just want your views on which are the few red flags that you are actually sounding off to your investors. First, on the AI bubble, is it really a bubble to your mind in terms of valuations or in terms of growth? And if that is the case, will India be a safe haven because we don't have too much of AI play in India so far?
Look, let's look at those valuations. So you've got the US price to sales ratio is now at 3.5 times. Okay, so that has now eclipsed the internet bubble at the turn of the millennium. If you look at the cyclically adjusted PE for the S&P 500, you're now at 38 times. So that's higher than the November 2021 peak. And so you only have the internet bubble for a comparable. So I would say from a valuation point of view, it's difficult to imagine those numbers being that much higher and not calling it a bubble. What you then have to do is look at the earnings projections, which are baked into these assumptions. So if you look at the long-run trend of the S&P 500, the EPS over 40 years, the compound annual growth rate is about 7%, just shy of 7%. So in 2024, there was 10% growth. This year, analysts are forecasting 12. And then for the next 2 years, 26 and 27, there's 14% EPS growth forecasted. So you've got 4 consecutive years where it's close to or double the run rate of the last 40 years. So that is quite exceptional. If you stitch all of that together, then you get to the largest deviation above trend earnings since 2008. And that was very brief, just before the global financial crisis. So I would say yes, from a valuation point of view, from an earnings forecast point of view, it does look as if the US market is priced for perfection at this point. As investors now, of course, what we're grappling with is whether the pace of capex is going to continue at the same rate. And that, I think, is going to be the canary in the coal mine, is the pace at which that may begin to slow down. Because, again, the numbers there are quite eye-watering. US capex sales ratio is now at 22%. The rest of the market, for the hyperscalers, okay, for the hyperscaler 5, the rest of the market is closer to about 7. You've got about $360 billion of capex now in the last 12 months for the hyperscaler 5. And I think the market is now becoming more attuned to some of the real genuine concerns out there, about circular financing, about the aggressive depreciation of GPU assets, about the potential for commoditization, and, of course, the potential for more disruption. And all of that ultimately could foster significant investor concerns and indeed hyperscaler concerns in the momentum of this capex going into next year.
Sure. Specifically from a US point of view, a couple of other risk factors. Inflation now, it's been sounded off. There are some tweets as well from Mr. Trump that, he's facing some inflation concerns there. And also a bit of a credit, risk within the banking sector in the US, or for that matter, the consumer credit as well. Are those real risks, according to your mind, which can have an impact on global equities?
It's interesting to see what the Federal Reserve is now focusing on. And within its twin mandate, you can see from the narrative that they now view the US labor market as actually being the greater risk. Okay. Obviously, the non-farm payroll data has gone quiet because of the government shutdown. But we've seen the ADP numbers, we've seen the challenger numbers, the private sector equivalents. And I think it's fairly obvious now that US month-on-month payroll changes are going to go negative. The lead indicators for payrolls that we look at show potentially quite a sharp reversal. Equally, the zeitgeist now feels quite different. When was the last time we had an equity bull market where the barometer of success of some of the largest participants is how many staff they're letting go? Microsoft, Amazon, letting tens of thousands of people go. So you can clearly see from the Fed body language that they are now more concerned about the labor market than inflation. That said, inflation at 3% is way above the Fed's comfort zone. If you look at the Empire State 6-month forward prices received index, that is indicative of US inflation being around 4%. And so ultimately, the Michigan the Michigan survey for household expectations of inflation hovering around 4.5% might not be wrong. You've got to a point where clearly the inventories that were built up before the tariffs went into action at the beginning of the year have now been exhausted. These prices are now getting paid on, basically passed on to consumers because low margins and retailers are unable to absorb them. Now, you mentioned on the credit side, I mean, the really important barometer to watch is US mortgage delinquencies.
Yeah.
And that rate is still very, very low.
Okay.
And that's because you have a large portion of US mortgage holders who have locked in at very, very low 30-year mortgage products. So they're not really feeling that, okay? But if you look at some of the other delinquency rates, like credit cards, auto loans, etc., they have spiked up, which definitely shows that there are stress points across the US consumer. There are some cohorts of the US consumer who have clearly exhausted all of their pandemic-related savings and are now beginning to feel some credit squeeze, for sure. But again, if you look at household balance sheets overall, you don't have to feel that uncomfortable. I mean, for instance, rewind back to the to the prelude to the global financial crisis. There was actually more debt than equity in U.S. household home ownership. Okay, so it was about, your equity was about 0.8 times the debt. Now that equity is 2.6 times the debt. So, US households are now an asset instead of a liability. And that's a huge difference. So as long as your mortgages are not going delinquent, as long as your household balance sheet looks okay, as long as corporate balance sheets look all right, then we probably don't have to be that concerned, although private credit has certainly been raised as a bit of a red flag. From a balance sheet point of view, maybe it's the government balance sheet that's a little bit more concerning. I mean, OBBA takes the trajectory of US government debt to GDP to about 120% over the next decade or so. If you look at the proportion of interest expense of the US government that is getting consumed by, out of the total of government receipts, it's now between a fifth and a quarter and rising. So that is clearly why, one of the reasons why Trump is so keen for the Federal Reserve to cut rates.